It's the age-old question. When do you take profits? Do you take profits after you make $1, after you make $10? Do you take your profits after the stock's been moving your way for 10 days, for a week? Nobody seems to know when to take their profits. So let me clue you in on a couple of different ways to look at this, and maybe this will all come together in the right way. Typically speaking, there's two types of profit targets, all right? There's a fixed profit target, and there's a trailing profit target. Now, let me give you the advantages, the upside, and the downside of each one. With a fixed profit target, you basically put up an exit, you look at your charts, you look at your data, you look at your exit price, and you say, well, when the stock goes from 80 to 100, I'm gonna get out. So you put your profit target, you put your limit order at $100, and you just wait for the stock to get there. That's what a fixed target is. You basically fix a price. It's just based on an arbitrary number. You figure that number out and you place the order there, or you sometimes don't even place an order. It's sometimes just a mental position, okay? So you figure it out. You know that level, it doesn't change. No matter what happens to the price of the stock, it just stays there, all right? And sometimes, folks, I use the word stock. You could apply this to any market: currency, commodity, option, Forex future, anything you want. So I use stock because I know that most of you watching this trade stocks. We have a big fan base of stock traders. So again, just because I use stocks, don't let the language turn you off. This applies to everything. As a matter of fact, I learned all of this in the day with futures contracts. So it makes no difference at all. So what's a trailing target? Well, a trailing target is something different. A trailing target is a profit target that you don't preconceive based on looking at anything. It's the way the market tells you where to get out. In other words, let's say you enter an asset. Let's say you buy a stock at $80 a share, okay? And the stock goes up to 90. Well, you bought it at 80, it's at 90, you place a stop at 85. Well, the stock continues moving higher. Now the stock moves to 105. Remember, you bought it at 80. So you put that stop, you move it from 85 to 95. The stock moves another 20 points. It's now at 125. You move that stop loss to 105 or 110. In other words, you're always moving that profit target, which is a stop because you're just raising your stop. And what happens is when the stock stops gaining momentum, it just stops you out. And that's your profit target. So a fixed profit target is a profit target that you conceive yourself. It has nothing to do with market action. You use an arbitrary number. It can be based on technical analysis, fundamental analysis, price levels, ratio of profit to risk level. It can be based on anything. It could be based on a dream you had last night. It doesn't matter. I'm just trying to explain what a fixed target is. Can you imagine trading by what you dreamt last night? I bet you there's a million good stories there, but I'll save that for another day. Anyway, I just can't resist sometimes. So that's your fixed profit target. Now, a trailing target, the market actually tells you when you should get out based on price action itself. Now, typically, if you've been following me and if you know anything about me, I always like it when the market dictates our behavior. Price, volatility. I don't like a lot of indicators because they cause too much noise to develop. So I like to look at pure price action, and I find that when you instill your values, your emotions, your analysis into the market, it tends to do worse than following price action over time. So I'm a big proponent for trailing targets, but here's the problem. There's a time and a place. All right. There's a time and a place for everything. And I know you're probably thinking weird things in your mind right now, but you don't have to. If you're trading time frame, if you're intending to hold the position for, let's say, 3-5 days, it's not practical to use a trailing target. It sounds good, but here's the problem with it. How much price accumulation, how much will the stock or the commodity or the futures contract, how much will it accumulate in value in 5 days? Now, things have happened. We've seen stocks double in price in 5 days, but typically, most of the time, the great majority of the time, you're not going to see a huge move in 5 days. So if your time period for trading, okay, is 3 days, 5 days, 7 days, you probably want to stay away from trailing targets because you're not going to have enough accumulation build up to give yourself enough of a cushion, and you'll just get stopped out right away. So it's not realistic. Fixed stops are good for 7 to 10 days max. Now, if you're holding positions for 3 weeks, 2 months, 3 months, still not too long, then you should consider trailing targets because then you have something to work with. Then you have a cushion room. You have something that the stock, you have some value that the stock or again, commodity or futures contract can accumulate to give you a cushion. In other words, let's say you bought an asset at 80, like we said before, and it goes to 100. Well, now you can put your profit target at 85 and trail, and now you have $5 that's in the can. That's a cushion. But it's not practical to do it every time a stock moves up $2. And I see this all the time. Oh, my stock moved up $3. I put my stop loss. I raised my stop loss, and I locked in $1.50, and then the rest got stopped out. That's not practical. Just take your profit target at $3 and call it a day. Don't play the trailing stop when your cushion isn't that high. So again, there is no best time to take a profit. It depends on your time period, on the volatility, on the assets you're trading. It depends on a host of different things. But I am going to offer you, so the biggest takeaway for now is if your time period that you're intending to hold a position, and don't do this, don't look at a stock, because I've seen people do this, I've done it myself. You see, you look at a stock, you say, I'm going to hold it for 5 days, you get into the stock, and then you change your mind. Oh, I'm going to hold it for a month. No, don't do that. When you enter a stock, put your stop loss in, put your profit target in, so you know before you enter that position, you can make a commitment to yourself before you enter that position to know what your profit target is and where your stop loss is. Don't do it after the fact. Your emotions will get in the way. And you'll start noticing that your stop loss is getting further away from where it's supposed to be, and your profit target's getting closer to the price of the stock. Don't do that. Put your stop loss and your profit target ahead of time. If you're using fixed stop, a real good rule of thumb is figure out what your stop loss is, double it, and make that into your profit target. In other words, let's say your risk is $4 or $5, okay? Your risk is $5, make your profit target $10. So let's say you bought a stock at 80, and if it gets to 75, you'll cut it. You'll get out of the trade. So make your profit target 90. Let's say you got in at 50 and your stop loss is at $3. Make your profit target $6. A 2-to-1 risk to reward is usually good, but you don't know what your profit target is till you figure out what your stop loss is because you have to double it and then add it to your price. So again, that works well for fixed stops, 2-to-1 profit ratio. For trailing stops, it depends. A good percentage rate is about 10%. When the stock moved 10% in your direction, you put a 5%, you increase your stop loss by 5%. Another 10%, 5%. So every time you get 10%, you add a 5% cushion. That tends to work well. Now, before I let you go, I'm going to leave you with a good tip, a really good tip. Congestion versus volatility. This will help you set your stops. Whenever a stock or a commodity or a futures contract is moving parabolically or being driven trend-wise with momentum, the odds are strong it's going to start congesting. If a stock is congesting, the longer it congests, the stronger the odds that it's going to break out. So when you're trying to figure out your stop losses and your profit targets, pay attention to whether the stock has been in a congestion cycle for a long time or has been trending for a long time. Because the longer it stays in one cycle, the stronger the odds it'll switch into another one. I hope that helps. I hope that answers the question of when to take profit. It's not an easy answer, but work with these two tools, the fixed target and a trailing target, and you'll be well off. Folks, if you like these videos, please like this channel and subscribe to it. I've got tons of actionable info coming your way. This is Roger Scott. Talk soon.